Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Girish, Kousgi, MD and CEO at Canfin Homes, joining in. Welcome to the show, Girish, and it's a pleasure to have you and speak to you after a really long time. Firstly, if you could just help us understand, from the time, the COVID impact began, we saw the lockdown in the last week of March, to now, how has the impact been on the overall sector as a whole?
Good morning. Thanks for the opportunity. If you actually let me take you back to 2 years back, especially after IL&FS and Diwan. After that, market was not very good. There were a lot of liquidity challenges. A lot of small HFCs faced two issues. One is flow of credit, and number two, at what cost they were able to raise funds. So this impacted the market. Market was quite low. Demand was low. It was slowly coming back. We could see at least from last September till about Feb, March, market was slowly coming back, picking up, and then COVID happened. So everything was pretty good last year. Demand was coming back, liquidity was easing with a lot of measures by RBI and NHB. And now suddenly COVID happened. So when COVID happened, shutdown happened abruptly from 24th of March, and therefore it had an impact in Q4. So I think the entire industry lost about 8 days of business, and most of the companies lost crucial 8 days from collection perspective. May not be true for Canfin because in Canfin, we have a daily collection mechanism, and therefore we had 8 days of loss of business, not really in terms of collection, we did really well. So after COVID, April was quite low for all in terms of business and also in terms of collections because the entire industry was busy working out morat policies, framing the policies, trying to cover the customer, make them understand what to opt for and stuff like that. So April was quite low. May last week is when at least we started doing business. So we did business in 1 week of May. It's last week of May, and June was pretty okay compared to May. So Q1 was not great, but definitely good compared to the situation what it was. If I have to compare it with April, May, and June, I think June was definitely better. So after that, every month we are seeing the demand is slowly picking up. So July was better than June, August was better than July, and I hope this trend continues in future as well.
Right. And that's the trend that we've seen, for Canfin Homes as well, as you mentioned, in terms of where the first quarter goes, where the numbers look pretty interesting. I mean, we've not seen that bad an impact that has happened in terms of where the numbers are concerned. Now, are you expecting this similar kind of performance to continue in the remainder part of the year?
See, there are a couple of things why the numbers were good. Numbers were good because the portfolio was pristine and our asset quality was pretty good. Bounce was quite low. Entire delinquent pool was quite low, and the impact of COVID was therefore there, but less to an extent compared to what the entire industry faced. So in terms of disbursements, Q2 would be definitely better than Q1 because every passing month the demand is coming back. Currently, we are at about 65% of peak levels in terms of business. So it will take another 6 to 7 months time for business to come back to the level of 85 to 90%, not 100%. So in Q4, you can see we will be at about 90% of peak levels. So that is what we sense in terms of impact on business. So there's going to be impact on disbursements in Q2, in Q3, in Q4 as well, to a certain extent. However, with every passing month, the numbers are improving.
Right. So, Girish, as we're talking about disbursements as well, if we see in terms of the advances growth, that has been tepid, and this was again, as you mentioned, on the back of lower dispersals. However, if we see the dispersals and fresh approvals were down around 80% on a year-on-year basis. Disbursements were down around 69% on a year-on-year basis. Uh, what's the kind of degrowth that you're expecting further in terms of disbursals? And if you talk about even the approvals on a sequential basis for the next quarter and for the third quarter?
So last year we had disbursed 5,500 crores. Now this year we will get very close to that number. So in terms of degrowth in disbursements, it will not be much. Maybe it might be maybe 10 to 15% max, because this year we lost at least 2 months.
Hmm. Hmm.
Right? Discounting the growth, what we would have shown this year, if COVID had not happened, now that will be the loss, and obviously there will be some degrowth. So degrowth will be in the range of 10 to 15% for Canada. So we'll be very close to last year numbers. So I don't think that is going to be a worry as such, because the entire market is now facing challenge of COVID, and COVID is a reality, and therefore this is on expected lines.
Absolutely. And then with this as well, if we see the net interest margins, Girish, we're almost at a 12 quarter peak. Do you think this number is a sustainable number at 3.7%? And if not, what is the range that we should be looking at which is sustainable for a company like yours right now?
If you look at a profile,
Mm.
profile is 99.9% retail, small tickets, skewed towards salary, funding only on residential and commercial, and therefore the yields are going to be much lower compared to the other segments. NIM of more than 3% is good enough. So 3.7 is definitely obviously good.
Correct.
So I think over a period of time, 3.7 is not sustainable. So maybe in next 3 to 4 quarters time, it might drop by 25 to 30 bips. We have a guidance of more than 3%. So we will stick to more than 3%. So it could be anywhere between 3.2, 3.15, 3.3. We are happy as long as it is more than 3%. If there's an opportunity, NIM will be higher. If there is no opportunity, NIM will be in excess of 3%.
Right. So, okay, that's the broad range we should be looking at as well with regards to net interest margins. Now, as you mentioned, with regards to the portfolio, where we are still skewed towards where salaried professionals are concerned, which is almost around 70-75% of the loan book. If you could just help me understand with regards to the moratorium as well. Now, how much of the loan book where people have availed moratorium as of today, and how are you seeing that scenario pan out where you've not really received any EMIs at all, where there could be a risk?
Actually, after Morat, we are almost halfway through, because
Okay.
September is the first month after Morat period, where you would know how many customers would pay and from what pool, the flow is going to happen. But
Hmm.
just to give you a context, our full Morat was 14%, check bounce and part Morat was another 14%. So totally
Hmm.
48%.
Hmm.
So during the end of Morat period, a lot of customers came back and paid. That is because a lot of customers, even though they had capacity to pay, they had opted for morat due to COVID uncertainty. So once they realize that COVID is a reality and things are slowly getting back to normal, they start paying is better than not paying, and therefore they came back and start paying, and therefore you will see this number. So we need to really act on not just 14, the entire 28%, because a like-to-like comparison with industry is going to be 14%, because I don't think so. Bounce and part morat is something which everyone talks about.
Hmm.
So we have this morat pool coming in from regular as well as delinquent. Now, as far as industry is concerned, we have the lowest delinquent pool, lowest delinquency, and therefore lowest SMS as well. Now, flow is going to happen from delinquent, flow is going to happen from regular. Now, if you have to split between profiles, we have salaried, which is 71%, and self-employed, which is 29%. Now, flow is going to be more in self-employed compared to salaried. Now, we've also assessed, amongst salaried, what could be the real impact. This was about 45 to 60 days back, just to understand what is the extent of job loss and what is the extent of pay cut.
Hmm. Hmm.
Number for us at least is not very big, it's very small. and therefore we feel that the flow is going to be quite less. In terms of, just to give you a comparison, on home industry is expected to increase NPAs by 100%. So NPAs will go up by 100%.
Hmm.
Non-home would be in the range of about 200%. So for us, this increase both in home and non-home is going to be far, far lesser because of the composition of our portfolio and the efforts what we put in collection and recovery in the last few months.
Right. So, taking this into consideration, are we expecting the asset quality to worsen, say, in the third and the fourth quarter? And if that happens, when do you see asset quality then again coming back to normalcy?
I think there is no exception for every single company, be it.
Absolutely.
So asset quality will worsen,
Hmm.
but the increase in NPA for us, we feel is going to be less. So Q3 NPAs will go up, Q4 NPAs will further go up, and we feel that we'll be able to contain in Q1. In next 4 to 5 quarters, we will be able to bring back NPA to the current levels. So it's a next 4 to 5 quarter play. NPAs will go up, and we'll be able to bring it back in next 4 to 5 quarters.
Right. And then with regards to where restructuring goes, what is the strategy that, Canfin Homes is using? Is it that, Canfin will be providing restructuring to majority of the customers, or it's going to be a particular book which you would be looking at where, restructuring facility will be given out?
No, we don't have a number in mind because it all depends on how many customers are going through stress. So any customer going through stress would come under the scheme of restructuring. So basically September and November, September basically we're going to assess how many customers we need to offer restructuring depending on customer comfort in terms of paying or not. Now, as I mentioned, we are almost halfway through. Now, if you look at the industry, the bounce rate has almost doubled for most of them,
Okay.
based on feedback whatever I've got. But fortunately for Canfin, there is an increase in bounce rate, but it is not substantial. So we feel that restructured pool is going to be less. At this point in time, it's difficult to give you a number, but what I can say is that we will look for customers who are under stress, both in self-employed and salary.
Mm.
We will offer restructuring to them. So obviously, we want to help customers. We will offer restructuring as per RBI scheme. But quantum, I think we will get to know probably after 30, 40 days from now.
Right. And then with this as well, now if you could just help me understand another issue that we are seeing in the housing finance space right now is that a lot of housing finance companies have not been able to pass on the interest rate cut because they have not got the passage yet from the banks as well on a totality basis. So what's happening is that the banks' interest rates are way lower than housing finance companies, because of which you have a lot of clients who want to make a shift from the current lender to move to another one. Now, if for a Canfin Homes, for example, if the interest rate is lower and if a customer has availed moratorium, are you as a company onboarding them, or you have put a stop on onboarding customers who have availed moratorium if it's a fast, if it's a shift happening from, a current housing finance company to yours?
Okay, you talked about three things. One is interest rate is downwards, and therefore some banks have passed on the interest rate benefit to HFCs and NBFCs. But with most of the banks, we need to negotiate. I think the fact remains that it doesn't happen by default. Some happen by default, maybe 10, 15 bips.
Hmm.
But otherwise, definitely you need to negotiate with all the banks to get the rates down. A. B, it's a fact that today all the PSU banks and large HFCs, they are offering rates much lower than most of the smaller HFCs. That is a fact. And this was there in the past, it's there now, it will be in future as well. So I think that has got nothing to do, because this it's about competition, and competition
Correct.
is everywhere and all the time. So I think that is not the concern. Uh, yeah, what has happened now is because of COVID,
Hmm.
demand is down. Now, most of the builders are under stress, and customers are also under stress because, especially people who are into business, there is loss of income for some time. and people who are salaried, for some of them there is a pay cut, and very few have lost jobs. So there is stress all over, and therefore demand is less, and therefore there was heightened activity of balance transfer.
Hmm.
Right now, it was less initially because of mobility issue. Neither the HFC staff or embassy staff were able to go out to source customers, nor customers are walking to the branch, and therefore it was quite less. But of late, last 1.5 months time, we've seen heightened activity on BT because demand is strong, especially in non-affordable space.
Hmm.
Now, at least we have not seen too many cases, but we have seen in the market customers who have opted for morat. If they want their loan to be transferred, or if they are looking for a new line, could be unsecured or secured. I think general view amongst all the bankers, NBFCs and HFCs is that let's wait for 2 or 3 months time post morat and let's see customer behavior. So I think this is the normal trend, not talking about cancel. So as of now, morat customers either doing a switch to other institution or availing new line, I think is literally not there, because I think no one is looking at that option now because of two reasons. One, customer is not going forward because customer knows that no bank is going to extend the
Hmm.
line at least for next 2 or 3 months time. To that extent, I think that pool as of now is not attended to. So other category, of course, BTs are happening. There is BT in and BT out. It's a balancing game. We also are managing that pretty well.
Right. And Girish, overall, you did mention in the conference call earlier as well that almost 70% of the business has returned in the affordable space. There have been improvement in collections as well. Now, builder apartment portfolio is something which is still struggling. Taking both of these into consideration, when are you expecting normalcy to return for both of these categories?
So let me talk about affordable, non-affordable. I'm talking about affordable because we are largely into affordable.
Correct.
Affordable, as of now, we are back to 65% of the peak levels.
Hmm.
Right now, in Q4, we would see 85 to 90%.
Okay.
The 10% I'm talking is because builder segment will take some more time, to come back. Maybe a couple of quarters more, maybe Q2 of next year.
Hmm.
Now, affordable will take much more time, especially non-affordable will take much more time. Non-affordable builder will take much longer time. So next Q4 we can see about 85 to 90% in affordable space. That gap is going to be only in builder. So to that extent, in next 3 to 4 quarters time, things should look good.
Right. And then overall, in terms of exposure, if you have to look at different regions as well, clearly we have South, which is the biggest market for Canfin homes. Rajasthan, Gujarat, Maharashtra, NCR, these are the other areas that we look at as well. Now, if you have to look at the non-southern markets versus the southern markets, where are you seeing growth faster right now?
See, as a profile, we like salad. As a geography, we like all the geographies.
Hmm.
So we are agnostic to go to any geography as long as it makes sense for us. As
Hmm.
long as we're able to get a pie from salaried pool there. So we started from Karnataka, and therefore we are largely present in South as a market, but we are present in 22 states in the country, and we do business all over. I think barring two states, which is Gujarat and Rajasthan, where the self-employed behaves equally well compared to salaried, as far as recruitment culture is concerned, this is going with the past history. So we are agnostic of any geography. As long as it makes sense for us, we go to any geography, but we like salary. So irrespective of the geography, our focus is largely on salary and SCNP with certain mitigants in place.
Right. So if you have to look at the non-southern areas as well right now, how seasoned is the book in the non-southern areas, and for how long have we been present in the non-south markets?
I think if you look at our expansion largely happened in last 5 years.
Hmm.
So I would say the book is fairly mature. because for a product like home, NPS will start showing up between 2 to 3 years. There will be early indicators in terms of 30 plus in 12 months, 60 plus in 24 months. So if you look at any of our internal parameters on delinquency, on the book quality, it's been pretty good.
Hmm.
However, there has been a difference in behavior compared to self-employed compared to salary. And
Hmm.
therefore, self-employed, the delinquencies are slightly higher compared to salary. This is true for the entire industry. In terms of vintage, we have sufficient vintage in most of the geographies where we are present. So that may not come in the way in terms of book quality going forward.
Right. So could we say that, the non-southern markets are the ones where we are present since the last 4 to 5 years?
We can take on an average more than 3 years.
More than 3 years, right? And again, another area in terms of geography which is seeing a good amount of development, Girish, is Eastern India. Now, a lot of development has been taking place there as well. Any growth strategy that Canfin Homes would have for that market as a whole?
See, every year we have a branch expansion plan. To be very honest with you, we have still not covered South itself. So there's
Hmm.
a more opportunity in Karnataka, and more opportunity in TN, in Andhra. So our strategy is very clear. When we open, we will open in all the geographies, but our thrust would be in states where we have a larger portfolio.
Hmm.
And about larger portfolio, I'm also talking about geographies outside the south,
Hmm.
because we want to open branches in clusters.
Right.
We don't want to be scatteredly present in a state. Just let's assume that we have 2 or 3 branches in a state. It doesn't make sense for us. Both from monitoring perspective and also from risk perspective, it's not an idealistic situation. And therefore, we want to open branches in clusters. When we choose a geography, we will open over a period of time at least 10 to 12 branches. So I think that's a strategy. So if it fits into a strategy, definitely we'll be open to open branches in any geography.
Right. So, what are the newer geographies that we will be looking to tap in FY21? I mean, will we really look at tapping newer geographies, or do you think this is a time of consolidation?
No, this is the time that we need to penetrate deeper into each of these geographies.
Okay.
If I have to call one state as a geography, I think we have to get deeper and deeper, because there is more opportunity in small towns and cities. That is where we are able to get better yields. And therefore, we want to focus on small towns, small cities, where we will be able to price it differently. The risk is lower, the ticket size is lower, property ticket is quite lower. So we are pretty comfortable there. And of course, I think the biggest of the thing is there's this competition there. So we want to focus on small towns and cities.
Right. And I think that's where, majority of the sectors are seeing growth, which is coming in right now. And it's rural versus the urban kind of a debate that's happening where majority growth is expected from rural. With this, a lot of risks that are associated right now with COVID. We've spoken about the affordable and the non-affordable housing space. However, Girish, the risks in developer loans have been increasing. And if that continues, the overall impairment levels also, if we saw, have gone up as per the RBI's report. Now, taking COVID into consideration, do you think this is going to be a concern for the sector as a whole?
To some extent, yes, and for some time, because all the developers, most of the developers are under stress now, because
Mm.
they, they are not getting enough credit flow, and also they're not able to complete all the projects. All the ready-made projects they're not able to sell because they find difficulty in reducing price, and there is no enough demand from customer side. So due to all these reasons, it's going to take longer time, but again it's a cycle. So after 3 years, everything will be back to normal.
Mm. Mm.
Everything will be back to normal. So it's only a question of time. Yes, next 2 to 3 years, it's going to be a tough time for this industry, especially in non-affordable developer space. Some of the big cities, high-ticket properties will see much longer time to recover. But yes, next 2 to 3 years time, I think every single company, barring 2 or 3, in HFCs, would try to stay afloat, would try to keep the asset quality well, would try to manage their collections better, so that after 2 3 years time when demand is totally back, they'll be ready to take off. So that pain will be there.
Right. And with this, right now when we see the financial sector as a whole, everyone is looking to go ahead and strengthen their balance sheet from here on. A lot of fundraising that's happening. For Canfin Homes as well, we've already received, approvals from the shareholders as well with regards to equity capital of almost 1,000 odd crores. But if you could just help us understand what is the first tranche that we look to raise, what is the timing, and the means of the capital raise that we are looking at from here on, because at least when we see the balance sheet, we're pretty much comfortable for the next probably 8 to 10 months.
In fact, if you look at both car and DER, both are comfortable.
Mhm.
And with every passing quarter, these ratios will further improve.
Mm, mm,
Still, we want to raise capital. We have plan of raising capital this year, maybe in the last quarter. In what form, what quantum, I think that we will decide at a later point of the year. But we do have plans to raise. Otherwise, we are pretty comfortable, because company is doing very well. We're able to show better profits quarter on quarter. So it's not an urgent need at this point in
mm.
time. It's an enabling approval. We will
Correct.
raise capital at the right time.
Right. And very lastly, Girish, with regards to where FY21 goes and 22, what's happening is, because everyone knows there is going to be an impact of COVID, everyone's negating FY21 and looking at FY22 earnings overall. So, what's the kind of growth that you're expecting in FY21 for the year? And what's the bounce back going to look like in FY22 according to you?
So this year you will see degrowth
Correct.
in industry because BTs won't help. BT will not, increase the overall portfolio of the industry.
Mm,
It's only from one pocket to the other pocket in the industry. So BTs will not help. Demand
mm,
is quite low. It will take long time, and therefore this year you will see a degrowth. And I doubt, whether next year you can see any growth. Even if there is growth, it could be either flat or maybe 1 or 2% growth you can see. That too you will see in affordable, non-affordable, it will be little difficult. So overall, it might be flattish or maybe slight degrowth. So year after next is when you will start seeing some kind of growth in the industry, maybe 5 to 6% is what industry is talking about.
So we're talking about FY23 year, that means.
Yeah.
Right. All right, Girish. Thank you so much for giving us these insights. I think great numbers that we've picked up from you as well about the sector as a whole as to what the trend could be looking like. Thank you so much. I hope you enjoyed the conversation as well. And we will see you back, very soon once again. Stay safe.
Thank you.